working. A very warm welcome from our side. Nice to have you here. We are happy to share in the next 45 minutes some insights from a tax and legal perspective about incentive plans for startups. To start, maybe a few words to our startup desk from Wenger Vierli. We are about 25 lawyers and tax experts working for the startup desk. We have more than 50 financing rounds per year. We can support more than 5 exits of a startup per year. We offer a one-stop shop for founders, for entrepreneurs, and have a strong network in the Swiss startup and VC ecosystems. A few words to myself. My name is Jonas. I'm a Swiss tax expert, covering all Swiss tax aspects of a startup, covering also incentive schemes as well as M&A transactions. Now I'm happy to hand over to Dominic.
Thank you, Jonas. So I'm Dominic. I'm not a tax expert, but I'm a lawyer and a public notary in the canton of Zug. And as a lawyer, I'm specialized in corporate law and transactions. I wish to focus on startups. So what I do on a daily basis is support startup throughout all stages, be it from incorporation through financing round and in exit transactions. And also on a daily basis, we help implementing and structuring incentive plans for startups. So that's why we're here today. So employees are usually a startup's greatest assets, right? It's success of every startup relies on the team. So you want to hire the best. And in order to be able to do that as a startup, you need to think about implementing incentive programs. So I'll first start off by sharing some legal aspects on incentive programs, and then Jonas will give you some insights on the tax key concepts, which are pretty important when it comes to incentive programs. And then I'll close by sharing some considerations on allocation and distribution of grants under an incentive program. So why should you think about implementing an incentive program? I mentioned it already. You want to hire the best in order to become successful. Still, you're a startup, and especially in early stage, you will probably not be able to pay market standard salaries, right? So you need to think of some other kind of incentive you can provide to your employees in order to attract and retain them in your firm. Since it's not only you as founders maybe that are interested in the success of your startup, but also your investors, there's also actually a high chance that your investors will ask you at one point in time to think about the implementation of an incentive program. And last but not least, it's also a great instrument to help you align interests in your company. So if everyone participates directly in the success of your startups, it helps you streamline interests, and it will make sure that every employee is fully committed to provide and support the success of your startup. Now, we get frequently asked when the right time is to finally implement an incentive program. And this can depend, obviously, but what we usually see is that when looking at the startup, like very early stage, incorporation phase, is that time you focus on your MVP, you're trying to get some traction. Often it's only still the founders team, so no employees yet. That's why at the incorporation phase, having an incentive program in place for employees can sometimes be helpful, but usually it's not needed yet. This changes though when you receive your first external funding. So if you're like pre-seed, seed stage, you have first investors joining you. As I mentioned before, very high chance that you'll be asked and you will want to implement an incentive program, for example, within a reasonable period of time after the closing of your first funding round, since through the funding round you probably also get some money which will allow you to hire your very first employees. If you go further down the line, you're at Series A or B stage, then having an incentive program is basically a must. So it's pretty standard and common to have one in place by that time. You might have built a workforce or a team already, but you're still focusing on growth. So you still are looking for top talents, which need to be incentivized. What needs to be considered here is that the values that are involved at the Series A or Series B stage can be pretty high already, right? So if you're raising a Series A round at the 20 million valuation, for example, and you have a 10% option pool reserved for employees, this is worth 2 million, so that's a pretty big number. And if you're thinking about, I don't know, allocating 5% to your CTO, that's worth 1 million, so that's quite a lot of money for you to give away. So here you just need to carefully consider to whom you're actually allocating grants and how much grants. Then moving on, if you reach like growth stage, maybe you're shortly before an exit, what we see often is that incentive program that you have implemented has been exhausted by that point in time already. But at that time, there can still be some key lateral hires, especially in view of an exit transaction, for example, can be a CFO or a CEO that still need some special kind of incentive, but then we're talking more about tailor-made solution rather than a general incentive program or plan. Now, when the time for you has come to implement an incentive program, you need to decide how you want to structure it, and there are different possibilities, which I summarized here. What you can do is, and that's the first point here, is obviously you can grant shares to your employees, meaning they will become a shareholder, they will be on your cap table, they will have shareholder rights, so they will be able to vote in shareholders' meetings, they have a right to dividends, liquidation proceeds, they are a party to your shareholders' agreement, and so on. Instead of shares, you could also think about granting them participation certificates. Participation certificates provide for the same economic rights, just as shares, so in terms of dividends, liquidation proceeds, but they do not come with voting rights, so that's why they're called the non-voting shares. So as a holder of participation certificates, you'll not be able to vote in a shareholders meeting. And that's something that might make you think that this could be an attractive solution for incentivizing your employees. Still, I think we see it in less than 5% of all cases because it brings some kind of additional complexity to your corporate structure, and this is something founders and investors usually want to avoid, which is why it's not a very common way of structuring an incentive program. On the other hand, very common is the granting of options under an employee stock option plan. Here you're not allocating shares to your employees, but options. And options is basically a right to purchase shares and acquire shares in the future, mostly after a certain period of time, the so-called vesting period. And I'll be talking about vesting later on a bit more. So the difference here is that your employees will not become a shareholder right from the beginning, but first they receive share options. They do not have any shareholder rights. Only once they exercise options against the payment of the exercise price, they'll actually receive shares in return, and then again become a shareholder with full shareholder rights. All the three ways of structuring incentive programs that I mentioned just now, they refer to a real equity participation, right? So your employees will actually become a co-owner of your startup. Benefit of that is that it provides a great incentive effect, right? Other benefit can be from a tax perspective, but Jonas will go into that in more detail. On the other hand side, it's for you, at least on a short-term perspective, like more complicated to implement and administer or maintain such kind of an incentive program. Because, first of all, I've mentioned it, your employees will become shareholders, so they are party to the shareholders agreement, right? You need to invite them to shareholders meetings. They can vote. As you will be issuing shares, at one point, you need to do capital increases, right? Maybe on an annual basis, you need to issue these shares, do a capital increase, which requires public notarization, which requires registration in the commercial register. So this comes all with a bit of effort and costs. This is not the case when you decide to go for an only virtual participation program. So if you're thinking about granting to your employees virtual shares, options for virtual shares, phantom stock, whatever, it's all the same. If you choose this solution, your employees will not become shareholders. They will never have shareholder rights. Instead, they are granted a very simple contractual right to receive a cash payment in a certain defined event. And that defined event can, for example, be an exit, right? So the cash payment that they are going to receive in an exit event is linked to the company value development. So what is actually done is that these employees in an exit will be treated as if they would hold real shares that are sold along in an exit transaction. So they will get cash instead. But they are not, they never became shareholders, which makes actually virtual incentive plans quite an easy option to implement, since it's a pure contractual agreement between the startup and the employees. That's a bit of a benefit for virtual participation programs. On the other hand side, it can come with some disadvantages from a tax perspective. Again, Jonas will tell you more about that. And it can also get a bit more complicated in view of an exit, because usually everything that needs to be paid out to employees under such a phantom stock option plan is just a liability of the startup towards your employees. So this will be a liability in the books of your startup, and that this can become sometimes a bit of a burden in an exit transaction. Obviously, there's not the perfect way of structuring an incentive program that just fits every startup, right? So for every startup, a different solution might be the right one. Even a combination of different solutions could work. And this is then usually something that you need to discuss in detail with your trusted legal advisor when setting that up. Summarize this here. We'll not go into any more detail of that. Actually, you can get the slides afterwards. So look, you can have a look at that yourself. So now, once you decided to what kind of incentive program you'd like to implement, you need to think of some key terms that are very important in every case, and I just want to highlight a few of them right now. First 2 points, they are relevant when we're talking about an incentive program based on real shares, so real equity, so your employees becoming shareholders of your startup. When they become a shareholder, they obviously have all rights and obligations of shareholders, and these rights and obligations of shareholders are usually governed in the shareholders' agreement. So what is very, very important is that you make sure that whenever an employee of yours gets an equity participation, that at that moment, this person becomes a party to the shareholders' agreement. So this should be a condition precedent for every employee to get shares in your company, because you'll not be able to force somebody to become a party or accede to the shareholders' agreement afterwards. So just make sure that, you remember of that. Another important point is think of some kind of a pooling solution for your employee shareholders, because dealing with like 30 employees being shareholders can be quite cumbersome, and usually also investors like lean cap tables. So it's a benefit if you have some kind of pooling solution in place for your employee shareholders, and this can be, for example, a very simple contractual pooling that can be included in a shareholders agreement, for example, by which an employee just authorizes, for example, a founder to represent him as a shareholder and exercise his or her rights as a shareholder. So this can make your life a bit easier in the future. Now, the most crucial and important provisions, they concern the vesting and the good and bad leaver provision. Now, I think most of you have already heard of the term vesting before, I assume, right? So what vesting means actually is that an instrument, and this can be a share or an option, is earned either over a certain period of time, that's when we talk about the time-based vesting, or upon achievement of certain milestones. That's when we're talking about the performance-based vesting. What we see in the market is usually a time-based vesting with a vesting schedule ranging between 2 and 4 years. Mostly it's 4 years with a 1-year cliff. Meaning that if you, for example, grant 100 options to your employee, subject to a 4-year vesting, that after 1 year, 25% of all these options vest, so they are earned, and by that become exercisable, free to exercise. So your employee can then, the 25 options can be exercised, and the employee can get shares in return for his options. And then just the remaining 75 options would just vest over another 3 years. Now, this vesting can not only apply to options, but also to shares. So if you, for example, do not grant options, but shares to your employee directly, although he will become owner of 100 shares, for example, he still needs to earn them. And that's when we talk about so-called reverse vesting. So it's then the shares being subject to a reverse vesting, meaning, for example, if your employee leaves, he gets 100 shares, leaves, I don't know, after a bit more than a year, and 25 shares have vested, he might be able to keep these 25 shares and has to give back only the remaining 75. This reverse vesting, this can be beneficial from a tax perspective, as Jonas will tell you again afterwards. That's also why we see a lot that an incentive program provides for the possibility of employees of a so-called early exercise, meaning that you're granting options to your employees and the possibility that they can immediately exercise them, even though they have not yet vested. So you're giving out 100 options, they can immediately be exercised, the employee will get 100 shares in return, and then again, the shares are subject to this 4-year reverse vesting schedule, for example. Now, what's always important is what happens if an employee leaves your startup, right? What happens to the options and the shares that have been granted to the employee? The consequences of that depend on 2 things. First, whether your employee is considered to be a good leaver or a bad leaver. And second, whether your options or shares that have been granted to your employee have vested or not. And you're completely free to determine in your incentive program on how you want to structure that and what should happen in case the employee leaves. What we see as a standard in the market is that, for example, an employee that is dismissed by the company for an important reason, so that would justify a termination without notice, that this is typically considered to be a bad leaver, right? And if you're familiar with Swiss employment law, you know that it's pretty hard to dismiss something someone without notice. So this person must have done some pretty bad stuff. And in that case, you do not want your employee to gain any benefit from his participation in the incentive program, right? So what you want in that case is that the employee just loses all his options, whether vested or not, and if he already received shares, that he needs to give back these shares at no costs. That's usually what you want then. On the other hand, if the company dismisses somebody without a reason, I don't know, market environment's not so good, you need to downsize, you need to let go of people, then such an employee would typically consider to be a good leaver, right? And in a good leaver event, you might want to say, oh, you get to keep your vested options, you've earned them already. Maybe if the person already received shares, you get to keep the vested shares, or you get a fair market value for them, you only lose unvested shares, so that at least such a good leaver gets some kind of benefit or gain out of his participation on their incentive program. Question is always a bit, what is an employee that terminates him or herself? Is it a good leaver? Is it a bad leaver? Is it something in between? Again, you're completely free to determine that. We see different solutions in the market here. This is something that always depends on circumstances. How it's then determined in the incentive program, it's something we discuss intensively with the startups when implementing such incentive programs. Irrespective of all that, what I want to take away as a recommendation from our experience over the last 10 years maybe is that if you have an incentive program that is structured by real equity participation, is that you make sure that when an employee leaves your startup, that you have a possibility to get all shares back, all shares. Even if someone is a good leaver, then you might have to pay him a fair market value. That's okay, that's fair, right? To still make your incentive program look attractive to employees. But what you don't want is a former employee that leaves your startup, still has a minority stake and interest in your company, maybe moves to the other end of the world, then you have a new financing round coming up, you need to get his signatures on new investment agreement, new shareholders agreement, you need to get a power of attorney for the shareholders meeting, the capital increase, and this person you cannot get a hold of that person. This can be a real pain in the ass for you and quite a red flag for investors as well. That's why our recommendation always is make sure to include a right of the startup of the company to be able to claw back the shares if an employee leaves. And since you might know the acquisition of own shares by a company is legally restricted, we always also recommend that the incentive plan is structured in a flexible way that the company could, for example, also designate another third party who would acquire basically or buy back these shares on behalf of the company. So that would be my key takeaway. Yeah, so now I explained you pretty much everything you can do from a legal perspective, and Jonas will now tell you what would not be ideal from a tax perspective.
Thank you, Dominic. As you have mentioned a few times, an incentive plan is something very good, very nice, but it's even better if the incentive plan is structured in a tax-efficient way. If we speak about taxes, we always speak about social security contributions. It's always both, and there we have a tax burden up to 50% in Switzerland. In other countries, it can be even higher. So if the entire capital gain of an incentive plan is subject to taxation for the employee, then he will lose half, or let's say she has to pay half to the government. The very general rule is that an employee or any monetary benefit which an employee is receiving from out of his employment is subject to income tax. That can be a cash component, that can be shares, that can be something different. And it's also not relevant whether he or she is receiving that monetary benefit from the employer company. It can also be a group company, can also be the founder, can be also any other party. So that's the general rule where we start, and in consequence that means if employees are receiving shares or PSOPs, ESOPs, these are subject to taxation, and as said, also subject to social security contributions like a salary. Let's see how the basic key concepts work. We will start with the shares. If an employee is receiving a cash bonus, then it's pretty simple. The cash he or she is receiving is the tax basis. If the employee is receiving shares, then it's a little bit more difficult what now the tax basis is. And for shares, the tax authority says it's the fair market value, which is in general the tax basis. If the company would be at the stock market exchange, then it's pretty simple. That's not in our case. If we have a share transaction where a third party is involved and shares are transferred from the startup, then we would also have an indication of the fair market value. But in the very most cases, this is also not applicable. And therefore, the tax authorities are offering that formula where we can calculate the so-called formula value. That's the practitioner's method, which you might already know, with 2 times the capitalized earnings and 1 times the substance value, which is then the tax basis for the shares which the employee is receiving. Every startup has also the possibility to define its own formula. So there can also be, for example, a multiple, an EBIT multiple or something like that. But then you need to agree that in a tax ruling with the tax authorities. If nothing is agreed, then that formula is the calculation for the tax basis of the shares. For a startup, we would also have some indications, or might have some indications about the fair market value if we look on the valuation of the financing rounds, but that would provide us very high numbers, and that would also lead to very high tax implications for the employees, and therefore the tax authorities are offering an exemption, mean if a company is qualifying a startup from a tax perspective, then such financing round valuations are not considered for defining the income taxes of employee shares. And the definition is basically very simple. The business must be carried out by a corporation. It must be a technology-based business model, which is also scalable. And the company must be in the build-up phase, means still in the loss-making situation. So in practice, for let's say early startup, that's not really an issue. Then we can apply that exemption if the startup is maybe a little bit more than early stage, already on the market since 10 years or in a profit-making situation. Then that exemption is something to be considered. Here you see the calculation of that formula value by numbers. But it's really nothing special. It's what you might already know from economic. Important here is the message on the right corner. The minimum value is always the substance value or the nominal value of the shares. And that's basically how we calculate the formula value for a startup, like equity value. And in case the equity would be negative, then the formula value is the nominal value. Now let's see in detail how the tax implications are for an employee share. If an employee is receiving shares, we have in general two taxation events. The first event is when he or she is receiving the shares. We have in that example a formula value of 9 Swiss francs per share. The employee is acquiring the share at the purchase price of 1 Swiss francs, like the nominal value. The difference of 8 Swiss francs is the taxable income, which is also subject to social security contributions. So the issue here is really we have the so-called dry income. The employee is paying taxes, but he or she is not receiving any cash. In most cases for a startup, that's not that significant. Also the substance value, that's something which can be somehow a little bit planned, what you have on the balance sheet at the year end. But the employees must be aware that they have tax implications when they are not receiving cash. That's one of the disadvantages of shares. But on the other hand, we have some significant advantages. The second taxable event of employee shares is at the time of the sale. We have here, for example, a sales price of 70 Swiss francs on the left-hand side. The formula value at the time of the sale is 30 Swiss francs, and that difference, in that example, 40 Swiss francs, is subject to income tax and social security contributions. You see the formula value increased during the holding period of the shares of 21 Swiss francs, and that difference is always tax-free. So that's one of the advantages. To be honest, for let's say, or for most startups, there's not much really an increase of the formula value in practice. But the shares have even have a second advantage, which is even more powerful, which you see on the right-hand side. If an employee is selling the shares after a holding period of 5 years, then there is no second taxation. The entire capital gain is tax-free. So that's quite a big advantage. In that example, you see the employee can sell the shares for 70 Swiss francs. He or she paid 1 Swiss francs, paid income taxes on 8 Swiss francs, and the 61 Swiss francs are simply tax-free compared to bonus salary, where you have in average a tax burden of 30 to 40%, maximum even 50%. That's the main reason why employee shares can provide a real advantage. I have to mention one exemption, which is also quite important in practice. Some cantons only allow a tax-free capital gain after a holding period of 5 years if the shares are sold to a third-party investor, like in an exit transaction. Cantons like Zurich or Schwyz, they will not grant the 5-year holding period if the shares are sold, for example, after 6 years to a founder or to the company. That's treated a little bit differently. between the cantons. But what is for sure, and it's also written in a circular, if employees sell the shares in an exit transaction after 5 years, the shares are tax-free. Let's see how it works for an ESOP. It's almost the same like for employee shares. What we have here in addition is if an employee is receiving the option, that is not a taxable event. So then nothing happened for tax purposes. When the option is exercised, then we have like the same taxation as for the shares, means difference between exercise price and formula values, taxable income, and then the same with at the time of the sale, which could then also be tax-free. Important to know about the option is that the 5-year holding period is only starting when the shares are acquired and not only when the options are acquired. And that's the main reason that Dominic mentioned before why we would recommend from a tax perspective doing a reverse vesting and not a vesting. If we do a vesting, the options vest over a period of 4 years, then the shares are acquired and then only the 5-year holding period starts. That would lead to a 9-year holding period until we have a tax-free capital gain. But if the shares are directly acquired, the 5-year holding period starts from the beginning, and the vesting period and the 5-year holding period, they are in parallel. As last point from the basic concepts, the PSOP is basically also from a tax perspective pretty simple, not only from a legal perspective. It's like exactly the same as a bonus payment. If the employee is receiving any cash out of the PSOP, then that cash is taxable. So pretty simple. On the other hand, there's also no possibility to generate a tax-free capital gain. We have summarized those 3 instruments on that slide. I would like to pick the main parts and take that opportunity to shortly summarize what we have seen so far. We have with the shares the possibility of the tax-free capital gain with the holding period of 5 years. Same applies for the ESOP, but there we have to be careful about the holding period. For the PSOP, we do not have that option. On the other hand, we do not have any taxation or no dry income for PSOP. There are only income taxes when the employees are receiving cash. That is the issue we have with the shares and also with the ESOP, that there is a dry income where the employees are faced with tax implications but not receiving any cash. The shares are also subject to wealth tax. That's not the case for options or for PSOPs. But there we can say, in particular for an early stage startup, the wealth tax value is not material, and the wealth tax rate also not. Therefore, that's something which is not that relevant for a startup. And finally, at the bottom, there are disclosure obligations for the startup as employer. That's applicable for all 3 instruments, but there we have to say that the disclosure obligations for PSOP, they are easier compared to ESOP or in particular shares, where quite detailed information must be made on the salary statement of the employees. On our webpage, you will find a guideline which summarizes the disclosure obligations in very detail for shares, ESOP, and PSOP. Now, I would like to pick up a few specific topics which you should be aware of, and there are some exemptions where the taxation of the employee shares are not applicable, and one very important exemption are the founder shares. Shares which are subscribed at the time of the foundation and still held by the respective founder. These are so-called founder shares, and these shares are not subject to taxation, can be sold anytime tax-free. If the shares could not be subscribed at the time of the foundation, for example, because there's still a non-competition agreement with the former employer or whatever, we have 2 exemptions, like the late co-founder exemption. If the founders have a written agreement at the time of the foundation that the late co-founder can subscribe shares later, then these shares can still be qualified as founder shares. By definition, the shares would be employee shares. It is important that there is the written agreement at the time of the foundation and that this also be implemented in a timely manner. Based on our experience, it's maximum 6 months after the foundation. Yeah, please.
This time, who is the owner of the share? The company and the treasury, or are owned by another founder?
Yeah.
Yep.
Yeah. Yeah.
You say by your experience in 6 months, it depends on the taxation office? Or
Yes, indeed. It's always the cantonal authority where the employee is living who is in charge for the tax assessment. And if we speak about incentive plans, then we have sometimes quite significant differences between the cantons. Maybe not in the basic concept, these are ruled by a circular, but if we speak about such exemptions, then we have differences between the cantons. There we can say, for example, Bern is very startup friendly, very open for economic arguments, also like Lucerne or Zug, and also the cantons in the eastern part of Switzerland, but for example Zurich, Schwyz, also the western part, they are stricter. And to be transparent here, the late co-founder exemption is rather rare, I would say, in practice, and it's also something where we recommend a tax ruling with the tax authorities. The second exemption, which is quite similar, is the dynamic equity split. The founders can also agree that they will rearrange the founder shares during 12 months after foundation. There must also be a written agreement at the time of the foundation which sets the criteria how the founder shares are reallocated. That can be, for example, based on the number of clients which every founder is acquiring, or whatever is preferred by the founders. But same here, tax ruling is highly recommended. Here we have included a graphic about the vesting versus the revesting, but that's something we have already discussed. Yeah.
Can I ask on the reverse vesting? So it would imply buying the shares when the shares are granted at the very beginning instead of option exercise. So you actually have a payment from the employee, which in your example was 1 CHF, which is I guess nominal value,
Yeah.
which is
Yep.
low. But assume options can be granted at Series A or Series B, typically with the strike price being the valuation of the company at the time, which starts to become a decent amount of money.
Mm-hmm.
In that case, how will you do it? You would still, if you go nominal, it's great for employees, but it's not really aligned with investors coming in. So as you think about options, reverse vesting, in a Series A, B scenario, you see what I mean?
Mm-hmm.
I mean, you're free to determine what the exercise price will be. Obviously, you're free to determine that it should be, for example, the valuation you applied in your Series A or whatever current financing round. Usually, that's not the case. Usually, employees get the chance to buy the shares for a much lower value, not only because they will get common shares and not as the Series A or B investors preferred B or whatever shares. So there's also justification behind that to give it out at a lower price. Also, it's mostly part of the entire compensation package. Otherwise they would not even be able to pay for them. I think what is mostly done, and Bionos can confirm afterwards, is that the exercise price is then not set at the valuation. It's also not set at the nominal value, but at the formula value. So the formula value that is calculated based on the practitioner method, for example, which is still much, much lower than the valuation you applied in your financing round. But if an employee pays the formula value, there's no dry income problematic about that.
The second very important exemption is that shares which are acquired at fair market value, these shares are not qualifying as employee shares.
This would be your case, right? So
Exactly.
if they pay the price in the round, that would be, they're not employee shares, yeah.
Exactly. So that possibility is always open, but there it's very important that the entire conditions of the transaction are really similar, like to the comparable transaction where we say that's a fair market value. For example, if in a financing round an investor is paying 20 Swiss francs per share, the employee as well, but have some lever clauses on the shares and the investor not, then in the sense of the tax authorities, we have not comparable conditions.
So it would mean for your employees, if they're paying 20 Swiss francs, you cannot do any vesting, any lever provisions, because they need to have the exact same conditions as investor if you want to have them, like the qualification as investor shares without taxation.
So that's, for an employee, that's actually quite a difficult one to get that exemption. But it's also applicable for also like investors or so who are also working and supporting the company very actively. Then, from a tax perspective, I would like to summarize really the key aspects which you should think about. The startup has the disclosure obligations, as mentioned. That already starts when you implement the incentive plan. So that's something to be considered. But even more important is actually the incentive plan is, as said at the beginning, is a very good instrument. But if the employees are faced with tax implications of up to 50% at the final end, then it's not that beneficial anymore for the employees, as you might have thought at the beginning. Therefore, taxes always goes with an incentive plan, unfortunately, and therefore it's really crucial that you start thinking about taxes when you implement the incentive plan. That's really structured in a tax-efficient way, and there the goal could be, should be, must be that the employees can sell the shares after the 5 years tax-free. Please keep in mind that from a pure tax perspective, the reverse vesting is more beneficial than the vesting. That can make a difference if we have 5 or 9 years for a tax-free capital gain. Please keep in mind the founder shares can always be sold tax-free, and the founder shares are really only the shares which the respective founder has subscribed at the time of the foundation and is still holding. So means, for example, the founder is giving shares to an employee. The employee leaves the company and will sell back the shares to the founder. Then these shares are then considered as employee shares and not anymore as founder shares. Therefore, please take care for the founder shares. It's like a unique opportunity, and if the shares are sold, then the opportunity is gone. And last but not least, the exit starts very early from a tax perspective. The first steps you actually set with the foundation of the company, and for a tax-efficient exit, it's a process which will always with you during the startup lifetime. Now I would like to hand over to you, Dominic.
Just a few remarks to close this session on allocation and distribution of grants, because we're frequently asked, how much do I grant to my employees, right? And there's no perfect number, obviously. This always depends on the circumstances. But what we see if we look at startups that we advise in an exit transaction is that around 15 to 25% of the entire equity at the time of the exit is held by employees. This does not mean that you start off with such a high number. What we often see is, for example, that in the first or after a first financing round, you create an option pool, for example, of 10%. You start off with that gets increased over time. So until an exit, you might end up somewhere in between there. As mentioned, it depends on the circumstances, right? So if you, for example, a startup with a single founder instead of a founding team, this might require that you have a bigger option pool for employees in order to be able to build a strong team, right? It also depends on the industry. So if you're in tech industry, you'll rely on highly specialized, well-educated people that are expensive, right? So you need to maybe issue more equity to them in order to compensate them for non-market standard salaries. We also see differences in geographical areas. So if you have, for example, a lot of employees in the UK or USA, You might also need to have a bigger incentive pool for employees because people from UK and USA are just used to getting more equity than, for example, people in Europe. And last but not least, skill set of employees, obviously. I mentioned that already. If your workforce consists mostly of back office people, you probably do not require that big of an incentive pool as if you have, like, as mentioned, highly educated, expensive people you employ. Now, how do you distribute within your employees? What we see here is that, again, there's no like black or white, always depends, typical lawyer's answer. But what we see is that from, for example, here we have 20% that has been allocated to employees, and that a big chunk of the entire pool is allocated to the very, very early employees, because that's the time when you do not have the money to pay market standard salaries, but it's the time where you need to build your team, you want to get the top talents. So a lot of equity is allocated to the very early employees. And when we're looking at functions, so I've mentioned it before, equity can be very valuable, right? So you need to be careful in considering to whom you're actually allocating how much under an incentive program. But what we often see is that, for example, a CTO can get between 1% and 5% of the entire stake, maybe key developers or salesperson between 1% and 2%, and then remaining employees around 0.5 or to 1.5% of your entire stake in the company. Yeah, I've mentioned all these already, so I can skip that. I think that was it, actually. We're also, run out of time by now. If you have any questions, I think we'll be here a few minutes. And we also have our booth downstairs. So just come by, ask your questions. If you want to get the slides, you can also visit our booth, so we can just take down, or write down your email address and we'll send you the slides. We also have beer and popcorn, I think, so that's a plus, And maybe just we're offering, like, at any time, a free 30 minutes call to discuss your ideas of an incentive program or any other legal topics. So, just